everybody for attending our annual Cuddle Roundtable event. We usually have it, in person, and this year is a little different because of COVID, unfortunately. And I was hoping to be able to see everyone. So if you guys want, you can put your pictures on so I can say hi to y'all. And make sure during this meeting today, we're going to have a lot of people here for our guest speakers. And so make sure you're interactive with them because this is your time. And you guys, you're the ones that are actually doing the work every day. And so you guys will have all the questions. The one good thing that I read this week about the pandemic is that the complaints are up about banks and their auto lending and how they are handling the processes. And so, I thought that was really good to hear because it's a credit union time and it's time for us to rise. And this is a perfect way to, help our members out, especially during this pandemic. So I also wanted to remind everybody that we have the ULend Academy. I don't know if everybody has seen information about it, but it is November 16th, and it goes over, it's an interaction with the individual people, and it will go over credit reports, structure loans, goes over the 5 C's of credit. It presents the right solution for members and closes with a purpose. And if you're interested, I can send you information about it. And then today, what we're going to have for our speakers is Aaron from DFR. He is going to be talking about indirect best practices and like what documents you should be utilizing in the indirect world with your members. Steve Saruta from Open Lending, he's going to talk about secure ways through Cuddle that you can actually increase your non-prime auto lending without adding risk to your portfolio. And then Doug Rusin from CUNA Mutual will be talking about credit washing and other indirect fraud areas that you need to keep your eye on. I know, I don't think there's much fraud up here with the indirects, but it's always a good, to keep your eye out on it and to know what to look for. And then we're going to be wrapping it up with our strategic partner, Origins or Cuddle, where Carol and Jeff will be talking about the economic forecast, what's been going on in Vermont, and some products and services that can help your credit union become more efficient with Origins. And I also wanted to give a shout out to Carol and Jeff because during this pandemic, I have been so thankful for all the resources and the webinars that Origins has provided to our credit unions free of charge. I think I've attended every one of them and I found them extremely helpful, and and it gives us the insight of what to expect every single quarter. And so I really have enjoyed that, and I hope everybody has the opportunity to watch it. And I know whenever I get a recording, I try forwarding it on to you guys. Also, one thing I wanted to know is how are things going? Are you able to engage with the dealerships right now? Because I know nobody's going out really on the road, and what you're doing and how we can help. So I don't know if anybody wants to start talking, but I was just wanting to know what everybody's been doing. If not, I'll call on you. Valerie, you like to talk. Go ahead. You can be the first.
I'd be happy to be the first. Yeah, so it has been, of course, as you know, AVCU went through a transition in regards to how we were managing our indirect channel, but getting hit with COVID and the pandemic and the stay home, stay safe executive order really put a crunch on things. So We've been spending our time speaking with the dealers over the phone. We're working on a plan now as to just kind of how to figure out what's the best way to interact with these folks long term. Because as most of you know, and certainly Christine, it's really important to be in the dealership, having a physical presence, being able to see inventory, get a sense of turnover at the dealerships, things such as that. And now we're at the mercy of picking up the phone and calling. We really don't know if they're busy. So it's been difficult, but we've recognized that this is our environment for probably the long term, that we're not going to be asking staff to go and visit all of these different dealerships. So we're working on a plan of more formalizing. Can it be by video chat? Can it be, just telephone? What's the best option? So I'm interested to hear what other people have been doing, because we do wonder, is that why some of our indirect volume has dropped off a little bit? Or is it the environment? Is it the used car inventory? So love to hear what others are doing as well.
Thank you, Valerie.
Of course.
And I'll just add on to what Valerie stated. This is Dawn Rinker. We did actually have a video chat with one of the dealers this week, and that went very, very well. I mean, it gave us the opportunity to see each other face to face, and just talk about some of the concerns, there are across the board, and, work with the dealers on some of the things that they would like to see. So I think that had a very positive impact. And I think going forward, if we can put, some plans in place to do that with our dealers, over time, it definitely will keep, that interaction there, and definitely help, build those relationships and keep them strong. Because I did notice that, in this period of time with COVID, we didn't have those, dealership visits, and definitely things were kind of lingering out there. So I think that will definitely help to make things stronger.
Yep, nope, that's good. I'm glad to hear people are using technology to talk to the dealerships. And also, if anybody doesn't want to speak freely, they can use the chat room, and then I can relay your question or anything. How about Tim?
Hey, good morning. Hey,
Good
so
morning.
how are you?
Good, how are you?
Good, thank you.
Oh, and
So,
congratulations.
thank you
Tim's
so
newly
much.
married.
Thank you. So yeah, it's been an interesting time this year for sure. I think one of the biggest, like everyone else has said so far, I know that my team is on the phone with the dealerships all day long, email obviously too, back and forth. I think that one of the biggest challenges that we're facing, and the dealerships, I will never say, I won't accuse them of being honest about their objective in trying to make a sale. And one thing that I know has been tough for a lot of them is it seems like there are fewer deals out there for them, and fewer sales, and inventory is a lot lighter. So a lot of feedback I've gotten directly is that they need to go where they're going to make the most money, and that might not be any of our credit unions here potentially, which is a challenge in and of itself. But I think that where we can help them, and where we usually do, is of course with our existing membership, but on some of a lot of the banks right now are not taking any deals unless they're the really squeaky clean, perfect borrowers. And I think that all of our credit unions here are much more willing to, go through that sort of relationship based lending, and really extend a little bit further than some of the bigger players in this space would. And I think that's where the dealerships are kind of coming to us and sort of relying on us, if that makes sense.
Oh, that's good. Thank you. How about Eric from Heritage? How are you doing?
All right, Dana, can you hear me?
I can, thanks.
Yeah, exactly what pretty much what everyone's saying. It's just more of a virtual. I probably spend more time texting dealerships now at this point than I have video conferencing or calling. So we just actually had a meeting with a local dealer face to face for the first time in about 6 months. That was on Wednesday, and it was good because we met in their boardroom. Everyone sat a chair apart. We all had masks on, so it was following that particular protocol. But overall, it's just the same. It's just a whole different environment.
Right, I know. It is a little different. How about Melissa from River Valley? Hello? How about Vicky? Are you on? From one credit union? I think one of the telephones. Oh, and Melissa doesn't have audio on her computer. Kara?
Hi, everyone.
Good morning.
Good morning. I think I've been doing a lot like everyone else, but I've been definitely trying to call a lot more. There's deals that I might not have looked at before that I'm considering now, and I call to get the whole story and just throw in that personal touch. And I know that the dealers have really appreciated that, and they've been very receptive to that. So, there's a lot with employment right now where normally we wouldn't consider it with new employment, but with COVID and all that happening, we've just been more open to listening to the stories and seeing what's going on in their lives so that they can make the deals that most might not. So
Yeah, that must be hard, with the employment. I would assume everybody's probably asking for a verification of income, which is probably a lot different than what everybody's used to, because nobody knows if they're, if they really are truly working now because of everything going on.
Right. And I've been also, we generally won't lend if they haven't been in the same position for over a year. And that's something we've taken into consideration because many have had to swap jobs to have a job because some just still are out or don't have the hours. So I've been taking all of that into consideration and really going the extra mile to help the dealers make these deals.
Well, good. Well, thank you. And I'm sure they really appreciate it.
Thank you.
And Aaron's here. Hello, Aaron. How are you?
I'm doing great, Christine. Good morning. Hello, everyone.
I don't know if you probably, because you don't go on the visits to the credit unions now, but probably some of us old-time people probably remember you. And Aaron is with FDR, and he's going to be going over some indirect best practices for us, and hopefully answering some questions. So like I said earlier, make sure this is your time. If you have questions for Aaron, make sure you guys, address them. If you need to use the chat box, I can make sure I can address it for you guys. Well, thank you, Aaron.
Thanks, Christine. Yeah, so as Christine said, my name is Aaron Ferenc. I'm the Director of Examinations for the Vermont Department of Financial Regulation. I've been in that position for about 6 years now, actually 5. This last year seems a lot longer, I guess. Before that, I was a field examiner, so I may have spoken or met some of you in your institutions throughout the years. So DFR regulates in the indirect lending space. We obviously regulate state chartered credit unions, but as a department, we also regulate motor vehicle retail installment sales finance companies. So those are the companies like Toyota Motor Credit or your other companies that are sort of competitors to the Cuddle loan program as well. So we do have the ability to kind of see that sort of other side of the business, as well as when we go into credit unions and take a look at their programs. So today we're going to talk about indirect lending. Christine, I believe you polled some of the members that are on today about sort of what questions they had. So I developed my presentation around those questions. But if anyone has any specific questions they have, please let us know. I'd rather this be a interactive situation than opposed to just me talking to a screen of names. So I'm sure every teacher right now understands that. The first thing we're going to talk about is sort of the documents that we look for in a Cuddle loan or even in an indirect loan. We'll touch base on the specific negative equity disclosure. That was something that we revamped back in 2017. We'll talk about what credit unions should be looking for when they are booking a new indirect loan with a new member. So this is the first relationship with your credit union that has been established. I'll also touch base on what sort of due diligence should be done on dealerships. There was some question about, credit unions going on the road to look at dealerships, and so we'll touch base on that. I'm going to also talk about, things to report to the board of directors, but also how do you manage and monitor the indirect program as a whole, not just individual loan level stuff, but the whole portfolio and certain challenges that can bring about. Then we'll talk about segregation of duties, and then also in this age of COVID and being on Zoom calls and doing things remotely, we'll touch base on electronic signatures. So that's kind of what we're going to cover. And I said, please interrupt or send a chat or turn on your mic and just let me know that you have a question. So the first thing that we're going to talk about is just the documents that we look for in a cut loan. Obviously the most important part is the note or the contract or the loan agreement, however you choose to describe that document. That's really going to be the basis of the transaction. As part of that document, and I'll talk about the disclosure later on, but the negative equity disclosure, once completed, does become a part of that contract. That's important in the traditional sales contract or sales finance contract space of, for example, Toyota Motor Credit, where the dealership is making the loan, Toyota is then buying that contract from the dealership. So it's essentially a two-step process. The Cuddle program is a little different. Credit unions have a little more control than that scenario. But it is a requirement of the regulation that the negative equity disclosure become a part of the contract and get transferred through any successive ownership or transfer of ownership of that contract. I think when our examiners are in the field looking at Cuddle loan files, we're really taking just a generic look at the files in terms of any sort of consumer lending that we would take place. What sort of credit information does the credit union obtain? Credit bureaus, credit scores, that type of information. It should really be commensurate with any other consumer lending that they do. What is the assessment of value? Is it a brand new car? Is it a purchase and sale agreement? Or is there any other sort of assessment of the value of the collateral in place there? How does the file document the borrower's income situation and other expenses related to making an appropriate determination of their debt to income ratios? And then, depending on your size, other things in the file will probably be like, once you have the loan originated and funded, the title, we'll look for that, the related application information. It really depends on how the program is set up to how you maintain that information. And our examiners will really be looking to see everything that would be, again, used to make a normal credit-based decision on a consumer loan. So I'll just move on to the negative equity disclosure because I think that's where a lot of confusion lies. So as I said, the current version of the negative equity disclosure, we revamped back in 2017. Well, we wrote the regulation in 2016, and it's Commissioner's Regulation B 2016-1, but it didn't take effect until 2017. The purpose of the document is to inform consumers of the impact of adding negative equity to a motor vehicle retail installment contract. Now, the thinking here is that with the cost and price of vehicles and sales tactics at certain dealerships, people were not always aware that they were borrowing more money than the actual cost of the vehicle or the actual vehicle price. And that was concerning, way back when the original negative equity disclosure rule was created, because there was the thinking that borrowers were, either being taken advantage of or misled about the terms of the transaction. And this document is really designed to show them what percentage of negative equity may or may not be in the actual deals of the transaction. So the key component is that even if there is no negative equity, this disclosure form still needs to be completed for that transaction. So if they a borrower has a sizable down payment and is still only borrowing a fraction of the term of the cost of the vehicle, that's fine. It still needs to be filled out and included with every contract. When we revamped the document recently, we through our normal examination cycle, we realized that there was a discrepancy in the way that the old disclosure form required the calculation to occur, and the way that Federal Truth in Lending Act, or Reg Z, allowed the creditor to fill out the contract. So we realigned the contract to provide creditors their option from Truth in Lending Act requirements to include whatever allowable information that they want in the cash price. But if they include it in the cash price on the contract, to then back it out of that cash price on the negative equity disclosure for purposes of calculating the negative equity. So that can be kind of a challenging situation. Sometimes dealers will just automatically remove that information without realizing that they only remove it if it was included in the cash price to begin with. So if their cash price on the contract doesn't have it included, then they don't need to then remove it from the actual negative equity disclosure. A couple other good points about the negative equity disclosure. There is a DMV and a DFR bulletin which discusses documentation fees. By rule, documentation fees are not something that is a finance charge. So it's essentially, $95 that every dealer charges every single purchase transaction for the filling out of the printing of the paperwork, sort of administrative things. Documentation fees must be included in the cash price because they're essentially charged everyone, and they should be included in that. Not every dealer will do that correctly, and that is something that it's not ultimately the credit union's responsibility, but it's something to know that is something that should be done and applied to the cash price. And then finally, one of the flaws about the negative equity disclosure is that the way it's laid out, it sort of, puts, let me see if I can find my copy here from my notes. It's not very, very logically set up. It includes the vehicle price up here and then the amount financed right here, when really the math would be the amount financed divided by the vehicle price. So it's just a flaw that we didn't really think through. But anytime the negative equity is in excess of 100%, it will show that, or anytime that ratio is in excess of 100%, it does show the borrower that there is negative equity.
Aaron?
Yeah, sure.
Sorry, I have a quick question. Have you reached out to the Vermont Dealer Association in regards to this form?
Yeah, we have actually. When we were in the process of rewriting the regulation, we had meetings with DMV, ourselves, and the Dealers Association at the same time to kind of think through how that should be done. And so they were able to provide feedback at the time that it was drafted and created. And then I'm not sure if you're aware of how the actual, sorry, I live near the airport, so if you can hear the jets taking off, I apologize, but there's a bit of a...
I hear them here too.
Okay. Sorry, it's distracting me. Hopefully it's not distracting. So yeah, part of the rulemaking process is that, we essentially do reach out to all of the stakeholders, credit unions and banks and dealerships to say, look, this is what the rule, we would like to change the rule for this reason. Here's what it's going to look like. Please provide feedback. And so we tend to try and work out any issues prior to its becoming final.
So Aaron, this is Valerie, and I'm with VSECU, and we have struggled with this form for quite some time. We feel very comfortable with how this form should be completed. What we run into is dealerships telling us, we're the only ones that, and I'm sure it's not accurate, but we're the only ones that have a problem with this form. We're the only ones that are asking them to fix it. And they want to know, who do they go to learn how to complete this form? And we initially, because I didn't know, we sent them to DMV. That's probably been a year and a half ago. I was like, go to DMV. And of course, DMV told them, hey, this isn't our form, so we can't help you. And we're trying to find instructions or something. So maybe Christine answered it with the Vermont Dealers Association. Is that where we should send dealers to? Because it feels like, you know, if we have 150 dealers, we have 130 of them are asking VSECU to train them on this form.
Sure. Yeah, no, I think you're kind of on the right track there. You know, it is sort of it's not really DMV's form, but it's a little bit DMV's form. But, you know, the dealership association really should be someone who could help them out. I would actually refer them directly to our regulation. It's available on our website, and I could even email it out to you. So if you had someone from a dealership that was complaining about how to fill it out, that, you know, you could email them the regulation and say, this spells out exactly how you need to fill it out. I mean, it does provide the instructions right in the regulation. So that would be another strategy I would recommend. And I do appreciate you actually taking the time to make sure that they fill that out. Because even, you know, like I mentioned, even when we're doing an examination of Toyota Motor Credit or Ford Motor Credit, you know, it's always the same issue. Dealerships have an incorrect way of filling it out.
Yeah, and I think this is maybe for Christine and others. Some of the feedback that we heard, and this might be because of the changes that were made, I think you said in 2017, is dealerships were telling us, well, it's all mapped through our system and this is the way it comes out, so this is the way it has to be. And we're like, well, it doesn't work. So I'm wondering if the representation that from Cuddle can maybe provide some, whether it's guidance on how to get corrected mapping on the form, so that, and again, they need to understand the form that they're producing so that they can ask the customer to sign it and send it to us and feel confident. But maybe Christine, that's a connection that you can make to help them out. So, yep. And Aaron, I think I've seen the regulation, but it would be great if you could email it. I don't know if you want to email it to Christine and she can forward it to everybody, or how you'd like to do that. I'd love to see that so that our staff has it and we can use it as a tool as well. That would be really appreciated.
And I can also reach out to Marilyn at Vermont Dealers Association and you know, just give her a heads up as well.
And I'd be interested if other folks are having this problem, because the dealers are telling us, VSECU, you're the only ones that are asking us to make sure this form is correct.
Any other credit union having this issue? You can either group chat me or...
Hey, Christine, it's Jeff with CU Direct. Can you hear me?
I can hear you.
Okay. So Valerie and I had discussed this a little while back, and just to clarify, it is, and it may be that change on 2017 that she mentioned. This is a form that's programmed in the dealer's DMS system. So it's like a Reynolds and Reynolds or an ADP or something like that. So for them to program it, they have to work with their DMS provider to fix that. It's not something that. So when they do, it's like when they print out the law contract, you know, and the finance charge, all that pre-populates on the form. This form is kind of loaded that way. So I don't know if that maybe is why, because the form changes, all the dealers may have had it programmed a different way before, and it's something that all their DMS systems would have to change. So I don't know if there's a simple solution, but I think getting the Dealers Association involved is probably the best way to go for that, because it does involve multiple DMS systems, and it's more of a, you know, dealer system versus the form itself. It's more of a mapping issue. So just kind of wanted to throw that out there so everybody understood how the dealer prints it out. It's through their DMS system, similar to all their other pre-printed forms.
Yeah, and just a little additional feedback to play off of what Jeff just talked about is that one of the reasons why it was a rule from 2016 that wasn't implemented until 2017 is we tried to give them time to address those sort of technology issues. So I would think after 3.5 years, they should probably be in the spot that it's not an issue, but that's not for me to say.
And we have Melissa and Kara both said that they are not having any issues with this form.
Well, I guess they only are buying paper from the dealerships who know how to fill it out, I guess. Good. Well, that's good to hear. It does, again, as I mentioned, it does come up even when we're looking at you know, big Ford Motor Credits or any of those other companies. So it is a common issue. Next, the thing that I wanted to talk about is sort of thinking about how this indirect lending becomes a portal to new credit union membership. So I'm sure a lot of the times there are contracts that come through, and these are members that don't already have a relationship with your credit union. So it provides an opportunity for the credit union, but it could also provide some challenges. I'm sure all of you are aware that anytime you have a new member, that there are certain Bank Secrecy Act and a customer identification program requirements that should be undertaken. So the first step really is to, well, number one, is this contract from someone who's eligible for membership in our credit union? So if you're a community-based membership, that's probably pretty easy to determine. If you have employee groups that you need to factor in, you need to factor that into your calculation. Second would be the CIP documentation process. How is that information obtained and documented appropriately so that the credit union can show that they are obtaining that information, or the assurance that that information is there at the beginning of this customer relationship. The third piece, which may be a bit of a challenge, is really the customer due diligence that you are engaged in with every new member. So BSA CIP requirements require every bank and credit union to form an initial understanding of the transactions and the services that customer is going to engage with at their institution. And then to, on an ongoing basis, monitor that information and those products and services for suspicious activity and other types of nefarious activity. So some credit unions, it really depends on how they've established their BSA CIP CDD program. And some credit unions have established that program. So at the inception of the new loan, that they do obtain that information. It is something that could really be a risk-based approach. So if you have a new customer who is, this is the only service that they're obtaining from you, just an indirect loan, you could go ahead and just wait and send out in a welcome packet some additional customer due diligence information for their membership share account. And again, it really should be risk-based. If you have a situation where the relationship started out that way, but then changed and they started to have direct deposit into their savings or checking account and started to do other services in your credit union, you really want to do some additional due diligence to make sure you had a proper understanding of their level of service and activity that they were going to be using through your credit union. The problem that really could arise is that, you know, improper identification or an improper assessment of the customer's risk could have a cascading effect on, you know, the effectiveness of your suspicious activity monitoring programs and other internal controls you have from a compliance standpoint. And then also you'd want to make sure that you're doing proper any sort of OFAC checks as well. Any questions on any of that stuff? Okay.
Sounds like everybody's good with it.
The next area that was talked about is, you know, someone implied that they have credit union staff that are going on the road to visit with dealerships. And what type of due diligence should they have in place with the dealerships, and should they be documenting anything? There is an NCUA letter to credit unions. It's titled 10 CU 15 that has a very good overview of the indirect lending process from a risk management perspective. So it takes a look at does the credit union have or does do its lending policies incorporate indirect lending into its overall risk management framework? Does it, does it also look at this relationship with each, not only with Cuddle, but with each dealership as sort of in the lens of vendor risk management? So, the same sorts of things that occur within that vendor risk management area should really be thought of when you're looking at evaluating dealerships. I would think more specifically, if you do have staff that are going to meet with dealerships and sort of, to use an automobile term, kick the tires of the dealership, so to speak, you really want to know, are they complying with the terms of the relationship or the basic rules of the program? So I think before you go, you'd also really want to know how well or how poorly the loans that they send you are performing. Are there a lot of chargebacks? Are there a lot of default within the first year? Is the credit profile something that, they say the credit profile is here, however, the actual performance has been less than standard? What is going on with the dealership? Is there any evidence of any suspect sales practices when you're at the dealership? How do you know you get a bad deal when you buy a car? Is because you bought a car. Sorry, that's a bit of a cynic in me, but the last time I bought a car, the salesman really just tried to focus on what my monthly payment was going to be. What do you want your monthly payment to be? Well, I also kind of want to know what the overall price is going to be and how long it's going to take for me to pay it off as well. So that there are challenges that could be, or red flags, if you will, that you could see through meeting with dealers and observing that. Is the dealer compliant with DMV rules and regulations? The state of Vermont DMV has inspectors that go out and they inspect every dealer, and whether or not it's a traditional name dealership or if it's just a mom and pop used car store or an auto body shop that sends in or sells a few vehicles on the side. But they do have requirements that are supposed to be met, and as long as the dealership's in good standing with DMV, I think that would be another area that you'd want to document and find out. I would be curious to know what kind of vehicles that they are selling. Is it a typically mostly new vehicles that they're selling? Are they selling some late model used vehicles, or God forbid, they're selling some really old and probably very untrustworthy vehicles, which if someone is buying one of those vehicles and it breaks down and repairs are costly, not only will that be a challenge for them, but making their normal typical payment may also be a challenge. So it could have ramifications down the road. I think overall, the key to having a good due diligence program is really making sure that you have the information on a per dealer basis to really evaluate their performance. So, each individual indirect loan is relatively small comparatively, a $20,000 car loan, $25,000 car loan. However, in the aggregate, the loan portfolio could be very large very quickly, depending on season and other market conditions. So having those policies in place about dealer performance will really help manage the program on an overall basis. And Christine, I'm not sure I think there might be a question now or a comment.
Let's see, it says, we rely heavily on Mary Beth for our information on dealerships. We then reach out to our branches in the local area to get feedback on them. From there, if we add them, we closely watch their deals with us. And she has not been disappointed with Mary Beth's recommendation at all. And Mary Beth is the indirect representative that goes to the dealerships, and she is an advocate for the credit unions. She doesn't say, oh, just submit loans to this credit union. She says submit them to all the credit unions.
Sure, sure. Well, yeah, well, that's good. I think the program does have that benefit that it's, sort of locally managed, and you have someone locally that is going out to meet with dealerships. I think from your credit union's perspective, you really still want to make sure that you have a proper understanding of what Mary Beth is doing, what she's looking at, and making sure that whatever is being done meets whatever sort of risk management policies or procedures that your credit union and your board decide that you're okay with taking. So yeah, I guess that's a good segue into sort of types of specific reporting for the board, and also really how the program should be monitored. That the letter to credit unions that I mentioned has a good section on this as well. And I think overall program monitoring is very important. One of the key tenets is really how well can you slice and dice the portfolio in terms of fully understanding the credit risk profile of the portfolio as a whole. So what I mean by slice and dice is, number one, do you have the ability to easily identify every loan that was made by XYZ dealership and how it's performed? What was the credit score at origination? What was the debt to income ratio at origination? What was the loan to value at origination? Once you're able to collect that information and monitor it on a regular basis, you're able to see how well this how well the indirect loan portfolio performs, but also how that sort of micro portfolio of the loans placed by that dealership are performing. From that information, you're able to determine whether or not you wish to continue that relationship with that dealership. Hopefully all dealers are essentially sending you, pretty good loans, but there could be situations where certain things just don't pan out.
And I find that very important, because I know when I was working at a credit union and I created a report that broke down all the individual dealerships, what loans they came in, it was eye-opening, because then when you went out on the road, you were able to be better prepared with what type of products they're giving you, if it's mainly C products, A.
Yeah, for sure.
Yep.
Yeah, I mean, even, how is the portfolio performing? What is the delinquency rate per dealership, so to speak? Not all core systems have the problem is that not all the core systems have the ability to track this information. So it may be a situation where it's appropriate to obtain an additional software package that can then collect and track this information for you. Or I think, Christine, in our talk, you mentioned that you had sort of more of a manual type spreadsheet that collected that information and tracked it that way. I think a good additional step in the program monitoring are the establishment of risk limits. The letter to credit unions that I talked about talks about how you really need to establish a overall risk limit of the size of the indirect loan portfolio as a percentage of your net worth. In Vermont, you really also should be factoring in, a Vermont credit union needs to stratify its loan portfolio and set up the desired loan mix that it wishes to have. So establishing an indirect loan portfolio as a percentage of your total loans is also a great risk limit. I think you should have concentration limits. So you'd want to establish concentration limits in terms of lending by credit grade, concentration limits in terms of lending from dealer to dealer. You'd want to have, and there could be different concentration limits for that matter. You know, with larger dealerships, you could be okay with a larger concentration limit. With smaller dealerships, you may want to, you know, set that bar a little lower to help control the risk in the portfolio. I think you want to make sure that you have, the credit union has a good program to monitor the growth in the indirect loan portfolio. You know, we've seen situations in real time where credit unions really went heavy into indirect lending. Credit unions and other financial institutions really went heavy in indirect lending, and the growth rates of their portfolio were such that it completely changed and altered their balance sheet composition, which really changes the risk profile of the institution as a whole. Now, you would not normally think that just indirect lending could do that, but with any program, if it's not managed appropriately, it could grow and again alter the risk profile. The other thing to monitor is I remember, you know, back in the day, a situation where I was at a credit union and they were funding so many loans that it became a liquidity issue. Their available cash was used up to fund all of these loans, and they had to then borrow in order just to meet the demand of the loans they had approved through the indirect lending system. That's not necessarily a bad thing. Again, it really comes down to how well you're able to manage it. I mean, if you don't know that this is occurring and you don't understand why it is occurring, that would be a problem. But it is okay for a credit union to borrow money. It is okay to increase deposits. And it's certainly okay to make loans, but again, it's making sure that the credit union is aware of exactly what is going on in all three of those areas as they interact with each other. I think a sound risk management practice is something called a credit score migration analysis. So you really, you're going to obtain the credit score at origination. It does cost a little bit per pull, but you can do a soft credit pull every year or so, and it just pulls the credit score for your customers, your members, and you can compare what was the score at origination, what is the score today, and that will help you identify if there's been any deterioration of the credit risk profile of the portfolio as a whole. So I have seen that in some really strong, well-run institutions before. And it doesn't affect the borrower's credit score because, again, it's just a soft pull. It's not a full pull, so it's not really something that would affect their score. For all of the areas that the credit union really should be establishing risk limits, those risk limits should be measured on a regular basis. And then they should be reported to the board of directors, whether that's on a monthly or a quarterly basis is really up to the credit union. But I think at the very least, a quarterly report of the performance of the portfolio is appropriate. Any questions on the board reporting or the program monitoring areas? I'm not sure if anyone in risk management is on the call or not, but maybe.
Anybody have any questions? I think we all must do a great job here.
Yeah, I mean, I think for the most part, all the credit unions that we see are very receptive to recommendations. So it is generally something that, when a recommendation is made, it is addressed and sort of not forgotten about, but it's just something that becomes a part of their normal process. So that's good. The next area that I had on my list was about the segregation of duties. I think someone had a question: can an underwriter fund an indirect loan even if they did not approve it? They would have different authorities within the system versus someone who funds these loans. I think anytime it comes to segregation of duties, the thing that really is important is that is an internal control from the institution's risk management process. And we're really looking for a second set of eyes that is reviewing the information and knows if this is going to be a good loan or not, or something that or a good transaction that the credit union should engage in. So I think in general that would be an okay process and what was described there. A red flag would be a situation where you have lenders involved in this indirect lending program who are compensated for on a per transaction basis, as opposed to someone who's on a salary or some other compensation basis. Just ramming through transactions to really pump up their volume without much thought to the true underwriting criteria necessary or implied by the loan policy or the credit risk profile of the institution. Sometimes segregation of duties is not always possible. So there are other internal control structures that could assist that. Is there an internal audit that goes ahead and randomly selects indirect loans and takes a look at them? Was it approved correctly? Did it meet all of the underwriting criteria? Was it funded correctly? Those sorts of areas. And then are there other system limits or other controls that could help alleviate some of the concerns about segregation of duties? The next topic that was on my list is very timely. In this age of COVID, you really don't want to have to meet face to face, and thankfully there are laws and statutes which mean you could go ahead and sign loan documents remotely and using an electronic signature as well. So Vermont's statute is called the Uniform Electronic Transactions Act, and it's in Title 9, Chapter 20. The basic tenets of this are that if two parties, so a creditor or a borrower, agree to use electronic information to consummate the transaction, then they're free to go ahead and do so. So it could be a very useful alternative to actually having to sign everything in person for that. There are a lot of third-party software providers that provide documents and ways to document an electronic signature. I'm not an attorney. I've looked at this in a little bit. It's my understanding, but check with your own legal counsel, that any sort of affirmative intent to sign something electronic will be interpreted as the borrower's wish to sign that document electronically. So. We as a department right now are signing things electronically, just saying, writing our initials and saying signed electronically. So as long as it signifies the intent, it theoretically should meet the requirements of that act and that law. But if you have any questions, you should really seek out legal counsel, and maybe the association has more input on that as well. But I'm a lawyer, so don't take my advice, but just know that there's a law that says you could probably do it.
So if they were to do it at the dealership, and say like it was Goss Dodge, and I went in and I asked them to send me the documents electronically by DocuSign, and it's going to my credit union, then Goss Dodge can send them to me electronically, DocuSign. Then they go back to them, and then Goss Dodge will send the paperwork along with the document saying that it was DocuSign and verified at this IP address?
As far as I know, yeah, that sounds like it would meet the tenets of the act.
Okay.
But again, if you had specific questions, I would take a look at that through legal counsel as well. Well, that kind of wrapped up the general presentation that I had. There was one other thing that I thought of after I'd written my notes, was that I mentioned that we do take a look at the Ford Motor Credits of the world, and there was a situation a couple years ago when the CFPB they had an issue with the way that America Honda Finance Company was pricing the loans within their overall portfolio, and And the CFPB cited them for issues concerning interest rates and the race of the customer. They were able to do some analysis and identify that America Honda Finance had allowed dealerships to mark up the price of vehicle, and it ended up indiscriminately affecting people of color in a negative way. So that I don't really have any advice to deal with that sort of situation, and I don't suspect that may be a rampant issue in Vermont. But it is something to keep in the back of your mind from a compliance perspective or from a risk management perspective as well, that you really need to comply with fair credit rules and equal opportunity rules with every transaction that you engage in. So with that, I guess I will leave it to any additional questions from Christine or from the group.
Thank you, Aaron. That was a lot of information that was, much needed for the credit unions. A lot of it is probably, a refresher, but, it's always good to know about, what we should be looking at for indirect loans. Does anybody have any questions for Aaron?
I do not. It was very helpful.
Oh, good. Thank you.
And I will definitely, I'll email that regulation to you, Christine, and you can distribute that out.
Yes.
And if you, in the future, you want to collaborate with some sort of I think in the past we've gone to a dealership roundtable, let us know, okay?
Perfect. Well, thank you. We really appreciate it.